You know, when we try to visualize the sheer scale of the digital world, we usually default to, like, social media as the benchmark.
Right, like how many tweets or photos people post.
Exactly. We think about how many times people scroll through their feeds or double tap a photo. But I want to start this deep dive with a number that just completely blew my mind.
Let's hear it.
4.4 billion.
Wow.
Yeah. That is 4.4 billion digital logins in just 90 days. And it wasn't people checking a social network. That is how many times people checked their money at Bank of America in the second quarter of 2026.
Which is just a staggering volume of traffic for a financial institution.
It really is. So today is Tuesday, July 14th, 2026, and Bank of America has just dropped their Q2 earnings report and their financial presentation.
And it is a sweeping data drop. Frankly, it's one of the most comprehensive looks at the internal plumbing of the financial system that we get all quarter.
Right. And that's our mission today. We are going to X-ray these sources. We aren't just looking at how a mega bank brought in billions of dollars. We're using Bank of America's data as a vital signs monitor for the entire global economy.
Because it tells you so much, right?
Exactly. What does this tell you about the health of the everyday consumer? What is the mood of the ultra-wealthy right now? And where are the global markets actually heading?
It's all in there.
Okay, let's unpack this, because the headline numbers are striking. In a single quarter, Bank of America generated $9.1 billion in net income.
Which is up 27% year over year.
Right. And they brought in $31.6 billion in revenue.
The sheer volume of those numbers definitely stands out. But for me, this isn't just about a bank making money. It's about the mechanics of how they made it.
You mean the segment breakdowns?
Yeah, exactly. If you look closely at those breakdowns, every single business segment, so consumer banking, global wealth, global banking, and global markets, they all saw double-digit net income growth.
Which is a highly unusual alignment, isn't it? I mean, usually if investment banking is booming, maybe the consumer side is tightening up or vice versa.
Right. One part of the business is usually subsidizing a softer quarter in another part.
Exactly.
But that kind of synchronized growth across consumer, commercial, and wealth sectors, that's a really rare indicator. It points to a highly resilient macroeconomic environment. You have the consumer spending, the wealthy investing, and corporations making strategic moves all at the exact same time.
It's less like a typical business cycle and more like, I don't know, a biological ecosystem where the predators, the prey, and the foliage are all thriving simultaneously without cannibalizing each other.
That's a great way to put it. Just a rare state of economic homeostasis.
But let's look at the underlying math here, because something jumps out immediately in the income statement. They had a 15% increase in revenue.
Which was about $4.1 billion extra.
Right. But that translated into a 27% increase in net income. So how do you turn a 15% boost at the top of the funnel into a 27% explosion at the bottom line?
The mechanism driving that gap is operating leverage. And this brings us to the operational engine of the bank.
Okay, break that down for us.
Well, while their revenue grew 15% to that $31.6 billion, their non-interest expenses only grew 8%. So expenses only hit $18.6 billion.
Oh, wow.
Yeah. So in banking terminology, they generated an operating leverage of 6.6%.
You know, I was trying to conceptualize this earlier, and it feels a lot like running a successful restaurant.
How so?
Well, imagine you own a really busy diner. Suddenly you're serving 15% more meals because there's a line out the door. But your rent is fixed, your utility bills are relatively flat, and you only had to increase your ingredient and staffing costs by 8% to handle the rush.
I see where you're going.
Right. That widening gap between the 15% extra cash coming in and the 8% extra costs going out, that difference goes straight into your pocket as pure profit.
That is exactly it. And the banking world measures the profitability of that operational engine using something called the efficiency ratio.
Which improved a lot this quarter, right?
It did. Bank of America's efficiency ratio dropped to 59%, which is down from 63% a year ago.
Okay, so an efficiency ratio of 59% means they are only spending 59 cents to generate every single dollar of revenue.
Precisely.
To drive that number down in an economic environment where inflation is still a factor is incredibly difficult. I mean, how exactly are they pulling that off without just aggressively slashing jobs and starving the core business?
What's fascinating here is why they were able to achieve this. The source material notes they are actually still investing heavily in technology, people, and their brand.
So they aren't just cutting corners.
No, not at all. They're achieving this 59-cent efficiency because their previous multi-year tech investments are finally maturing. Think about things like their digital onboarding platforms and their AI assistant, Erica.
Right, right.
The digital infrastructure is absorbing the increased transaction volume without triggering a proportional increase in human headcount.
So instead of a branch employee taking, what, 45 minutes to open a new checking account, verify identity, and issue a card, the customer just does it on their phone in 5 minutes.
Exactly. And it costs the bank fractions of a cent.
That's wild.
The marginal cost of servicing an additional digital customer approaches zero. That right there is the engine driving the 27% net income jump.
It is a beautifully designed operational engine. But here is the friction point. A bank cannot remain efficient if its customers are broke.
Very true.
To understand if this profitability is sustainable or just some temporary sugar high, we have to look at the foundation of the bank, which is the everyday consumer.
And the data regarding the consumer is arguably the most surprising part of this entire report.
Walk us through it.
Well, the consumer banking segment brought in $3.3 billion in net income. That's up 10% year over year. And total credit and debit spend hit $266.1 billion for the quarter.
Which is up 9%.
Right.
And the sources show that travel, entertainment, and food spending are all exhibiting year-over-year growth. But, and let me push back here for a second.
Sure, go ahead.
If Bank of America's own global research estimates U.S. CPI inflation at 3.0% for 2026, I have to ask, are people spending 9% more just because everyday items cost more, or are they actually buying more goods and services?
That is the critical distinction we need to make when looking at consumer health. And the payment spend breakdown provides a really clear answer to that.
Oh, really?
Yeah, they parse out the difference between transaction volume and dollar volume.
Okay.
Transaction volume, which is the actual physical number of times someone swiped a card or tapped their phone, that is up 4%, while the dollar volume is up 7%.
Got it. So they are swiping more frequently in addition to spending slightly more when they do.
Exactly. Consumers aren't just passively absorbing inflation. That 4% transaction volume increase proves there is real underlying economic activity happening. People are actively choosing to make more purchases.
Okay, but are they financing that lifestyle on borrowed time? Because, I'll be honest, this is the specific statistic that made me do a double take.
The credit card numbers.
Yes. Credit card charge-off rates currently sit at 3.55%. And both early and late-stage delinquencies actually improved for the fifth consecutive quarter compared to the previous year.
5 straight quarters of improving delinquencies is a definitive trend. It's not a fluke.
Let's drill into the mechanics of that for a second, because if early-stage delinquencies are dropping, it means fewer people are missing that initial 30-day payment window, right?
Right.
Which means the bank doesn't have to set aside as much cash in loan loss provisions to cover potential defaults. That essentially destroys the popular narrative that the consumer is over-leveraged, maxing out their credit cards to buy groceries, and careening toward a cliff.
It comprehensively refutes that narrative. I mean, when you consider the sheer scale of Bank of America's retail footprint, they have 38.7 million consumer checking accounts.
Yeah.
And 92% of those are primary accounts.
Meaning that is the core account where people's paychecks are directly deposited and where their mortgage or rent is paid from.
Exactly. That isn't a secondary savings account that just sits there. That is the central nervous system of a household's finances.
Which gives Bank of America this unparalleled real-time window into the American public, and their actual spending and borrowing habits suggest a really resilient middle class that's managing their finances with a high degree of discipline.
Absolutely.
Which is huge, because if you've been doom-scrolling about an imminent recession or watching videos about how the middle class is drowning in debt, you really have to weigh those fears against this actual hard data.
You do. But the numbers just don't support the doom and gloom scenario right now.
But we can't just look at what the consumer is doing. We have to look at how they are interacting with their money. Because the behavioral shift hidden in this report perfectly explains those earlier efficiency numbers we talked about.
It all ties together. The data reveals a structural transformation in how banking is conducted daily.
Here's where it gets really interesting. Earlier we mentioned that 4.4 billion digital logins number.
Right, the 90-day stat.
Yeah. Well, the report notes that 80% of Bank of America households are now actively using digital platforms. Zelle users are up to 25.5 million, and they processed $160 billion in the quarter alone.
Just massive volume.
And Erica, the AI assistant, has 24.6 million active users, which is up 23% year over year. But here is the metric that changes everything. 70% of total sales were digitally enabled.
When 70% of your new business originates on a screen, the fundamental architecture of the corporation shifts.
Wait, think about that. If 70% of sales are digital, they aren't paying a traditional banker's commission for those originations.
Mhm.
They aren't paying for the real estate overhead, the utilities, or the physical marketing materials for those specific transactions. I mean, this isn't just about providing convenience for the user. This is a ruthless, highly effective cost-cutting mechanism masquerading as a feature.
You were looking right at the engine of that 59% efficiency ratio. The report highlights that 83% of eligible brokerage accounts were opened digitally, and 76% of checks are deposited through automated channels.
So no one is standing in line with a paper check anymore.
Exactly. The bank evolves from a brick-and-mortar institution burdened by massive physical overhead into a highly scalable technology platform that just happens to hold capital. And it fundamentally alters the lifetime value of the customer.
Because once you are in that digital ecosystem, the friction to leave becomes enormous.
Oh, absolutely.
If you've got your direct deposit set up, your Zelle linked directly to your phone number, and you rely on Erica to automatically categorize your spending or find past subscription charges, the sheer logistical headache of switching to a competitor is a massive deterrent.
It creates an incredibly sticky ecosystem. The acquisition cost per customer plummets because they are essentially onboarding themselves via the app. And then retention skyrockets because the integration into their daily life is too deep to easily untangle.
Okay, so the everyday consumer is stable, they are completely glued to their banking app, and they are paying their bills on time.
Correct.
But stable, everyday checking accounts don't generate a 34% jump in earnings per share.
Yeah,
For the truly explosive growth this quarter, we have to look up the wealth ladder.
we do.
We have to look at Wall Street, the institutional investors, and the corporations.
And that is where the growth curve goes vertical. The Global Wealth and Investment Management segment saw net income rise 42% to $1.4 billion.
Wow.
Yeah, and client balances hit an all-time record of $4.9 trillion.
That's trillion with a T.
Trillion with a T. Meanwhile, in global markets, which encompasses their trading operations, net income was up 72% to $2.6 billion.
Yeah.
Equities revenue alone was up 70%, and investment banking fees jumped 50% year over year to $2.1 billion.
Okay, wait. I want to push back on those global wealth numbers for a moment.
Go for it.
With client balances sitting at 4.9 trillion, how much of that is just a mirage? I mean, if the broader stock market has generally been going up, of course the total value of those managed accounts will inflate. Are they actually convincing ultra-wealthy individuals to hand over fresh cash, or are they just coasting on a rising market tide?
Analysts look very closely at that exact dynamic. Market valuations absolutely provided a tailwind, no question. But the source data isolates the organic growth. They saw solid assets under management AUM flows.
How solid?
Well, they brought in $14 billion in net new flows just in the quarter, and $78 billion since the second quarter of 2025.
So that is actual new liquidity being deposited and put to work, independent of asset appreciation.
Furthermore, they added 6,000 net new relationships with clients who have over $500,000 in investable assets, and that's across both Merrill and the private bank.
6,000 new high net worth clients in 90 days.
Yes. In a highly competitive wealth management sector, acquiring 6,000 high net worth relationships in a single quarter requires aggressive market share capture. They're actively poaching clients from competitors, not just riding the market upward.
That makes sense. And what about the corporate side? Because we saw a 50% jump in investment banking and a 70% jump in equities trading. What is the underlying mechanism driving that, and what does it tell us about the broader economy?
If we connect this to the bigger picture, it serves as a major psychological indicator for the corporate world.
How so?
Well, for a long time, corporate CEOs and institutional investors were basically playing defense. They were hoarding cash, worried about inflation, rate hikes, and a looming recession.
Right, everyone was just waiting for the other shoe to drop.
Exactly. Now, investment banking fees are generated through debt underwriting, advisory services for mergers and acquisitions, and equity underwriting, like IPOs. A 50% jump indicates that defensive posture has been entirely abandoned.
Meaning companies are confidently borrowing money to build new facilities, they're buying up their competitors, and private companies are finally going public.
The risk appetite has returned. And that 70% jump in equities trading, that shows that institutional investors, hedge funds, asset managers are aggressively repositioning themselves in the market, utilizing the bank's trading desks to execute complex strategies and hedge risks.
So the animal spirits have firmly returned to Wall Street.
They absolutely have.
It's as if the entire financial ecosystem took a collective deep breath, looked at the data, and decided, the water is fine, let's dive back in.
Yeah, that's exactly what the numbers reflect.
Everything is firing on all cylinders. The consumer is spending, the traders are trading, the corporations are expanding. But, and this is a big but, what happens if the economic weather abruptly changes? A bank this size has to account for systemic shocks.
Oh, without a doubt.
So we need to look at their fortress defenses.
Yeah.
Just how thick are the walls of a $3.5 trillion megabank?
Well, the regulatory environment post-2008 fundamentally altered how banks build those walls. And Bank of America has constructed an immense buffer. Let's start with liquidity.
What?
Their average global liquidity sources sit at $947 billion.
Nearly $1 trillion. In highly liquid, unencumbered assets. So cash and easily tradable government securities just sitting there, instantly available to meet withdrawal demands or weather a liquidity crisis.
It is a profound safety net. But the more critical metric for structural solvency is their CET1 capital ratio, which currently sits at 11.2%.
For the listener, CET1 stands for a Common Equity Tier 1.
That's right. It is a regulatory measurement of a bank's core equity capital compared to its total risk-weighted assets. Essentially, it acts as a financial shock absorber.
Right, so if the bank makes bad loans and takes losses, CET1 dictates how much of the bank's own equity it burns through before it ever touches a single dime of depositor money.
Exactly. And at 11.2%, they're operating well above the regulatory minimum requirements. They are voluntarily holding more equity buffer than the government mandates.
And because they have fortified that balance sheet so thoroughly, they have the flexibility to reward their equity holders.
Right.
I mean, they returned $8.0 billion to shareholders in a single quarter.
Yes. $6 billion of that was executed through stock buybacks, and $2 billion was distributed in dividends.
Which is just massive. To authorize and execute the repurchase of $6 billion of your own stock in a 90-day window is the ultimate signal of executive confidence.
I agree completely.
A management team does not drain $6 billion in capital if they believe a systemic storm is brewing on the horizon.
They don't. However, the presentation data does highlight one specific vulnerability, and it revolves around interest rate sensitivity.
Okay. Let's dig into that.
A massive portion of Bank of America's revenue is generated through net interest income, or NII. This is the spread between the interest they pay out on your deposits and the interest they charge on loans, mortgages, and credit cards.
Got it.
That NII was $16.0 billion this quarter, which is up 9%.
So as long as rates stay relatively elevated, they make a massive spread.
Yes, but the bank provides a forward-looking sensitivity analysis. The mechanics of their balance sheet mean they are asymmetrically exposed to rate movements.
Meaning what exactly?
Well, if the yield curve were to experience a 100 basis point parallel shift up, meaning rates broadly rise by 1%, the bank estimates it would gain an extra $1.0 billion in NII over the next 12 months.
Because they can quickly adjust the variable rates they charge on loans upward.
Exactly. But if there is a 100 basis point parallel shift down, meaning central banks cut rates by 1% Bank of America models, that they would lose $2.2 billion in net interest income.
Wow, that is a stark asymmetry. They stand to lose more than double from a rate cut than they stand to gain from a rate hike.
Yes.
Why does a rate cut hurt them so disproportionately?
It comes down to deposit betas, which is the speed at which a bank adjusts deposit rates compared to market rates.
Okay.
When central banks cut rates, the yield the bank earns on its massive portfolio of variable rate loans and new fixed-rate assets drops immediately. But they can't always push the interest rate they pay on customer deposits down as quickly or as aggressively, especially if they want to retain those deposits in a highly competitive market.
So the spread compresses rapidly.
Exactly. And this raises an important question for the immediate future. As we look ahead to late 2026 and 2027, if central banks globally begin an aggressive rate-cutting cycle to stimulate growth, that spread compression will put significant downward pressure on Bank of America's most reliable revenue engine.
Because if a rate cut strips $2.2 billion from their top line, they cannot easily replace that with fee income. They are forced to lean even harder into the operational engine we discussed earlier, which means defending that 59% efficiency ratio becomes an existential priority. They will need their digital technology and AI automation to ruthlessly suppress costs to offset the shrinking interest revenue.
Which brings us to the ultimate reality of what this institution has become.
So what does this all mean? If you zoom out from the balance sheets and the basis points, Bank of America's Q2 2026 is a detailed portrait of our current economy. We are looking at a society where everyday consumers are safely managing their debt and continuing to drive economic activity entirely through digital interfaces.
Right.
Concurrently, corporations and the ultra-wealthy have shed their caution and are aggressively utilizing the capital markets.
It is a synchronized economic expansion, completely underpinned by widespread technological adoption. The institution is highly profitable because the underlying client base, from the primary checking account holder to the institutional asset manager, is financially healthy.
But I want to leave you with something to chew on, something that isn't explicitly spelled out in the earnings presentation, but is the inevitable endpoint of everything we've analyzed today.
Let's hear it.
We established that 70% of Bank of America's sales are now originating digitally. AI assistants like Erica are handling tens of millions of users, intercepting customer service inquiries, and executing billions of interactions on glass screens rather than in physical locations.
Yeah, the digital shift is absolute.
The traditional bank branch with the vault, the tellers, and the mahogany desks is rapidly becoming a relic.
The physical branch is transitioning into a highly specialized advisory center for complex wealth management, rather than a utility for daily financial transactions.
Right. And if a $3.5 trillion mega bank is systematically closing its physical footprint and transforming into an infinitely scalable financial software company, what does that mean for the commercial landscape of your local Main Street?
It's a huge shift for local communities.
And perhaps more importantly, as every single swipe, tap, direct deposit, and transfer is optimized, categorized, and analyzed by their proprietary AI to drive down their efficiency ratio, who ultimately owns the narrative of your daily life.
It's a profound question of data privacy and control.
As the bank relies more on data to maintain its profit margins, are you simply a customer receiving a service, or are you becoming the most valuable behavioral data set in the world? Thank you for joining us on this deep dive. Keep questioning the headlines and keep exploring the hidden stories inside the numbers.